Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing global diversification and home country bias. Last week, we explored the idea of the US exceptionalism premium and tried to cover whether or not there was a justification for US stocks trading at traditionally higher valuations compared to stocks in other markets. This week, we are going to look at the flip side of this coin and discuss global diversification, its impact on portfolio performance, and whether it's worth implementing in your own portfolio. Traditionally, investors' portfolios are heavily biased towards stocks from their home country, but we'll look at ways that investors can gain exposures to new industries and trends that may not be represented in their domestic market. Before we dive into what happened in markets this week, here's our quote of the week from John Templeton. Diversification is a safety factor that is essential because we should be humble enough to admit that we can be wrong. Now, let's dive in. Here's a quick summary of what's been going on. First up from Reuters, the Fed delivers oversized rate cut as it gains greater confidence on inflation. What's our take on this news? Borrowers will be happy, while savers, not so much. You could say these rate cuts were priced in already because long-term mortgages, corporate borrowing rates, and term deposits had all already fallen in anticipation of this September rate cut. Fed policymakers see another 50 basis point worth of cuts in 2024, which would take the official cash rate down to 4.25% to 4.5%. Rate futures traders are expecting even more than that and are pricing in 4% to 4.25% by the end of the year, probably because they think the Fed has acted too late. Some large central banks like the European Central Bank, Bank of England, Reserve Bank of New Zealand, and Bank of Canada have already started cutting rates, with more likely still to come. While historically speaking, we have never achieved a, quote, soft landing after a bout of inflation, that isn't stopping the Fed from trying. Analysts anticipate greater allocation to risk-on assets due to these cuts, meaning equities could continue to receive inflows over the coming months if more cuts occur. Next up from NPR, TikTok argued against its US ban in court. What's our take on this news? There are 170 million users at stake, and it's a matter of free speech versus national security. So far, the judges seem dubious about TikTok's pleas that the former is more important than the latter. If TikTok US isn't sold to a non-Chinese company or group of investors by January 19th, the app will be banned in the US, unless of course an extension is granted. Many companies will be impacted if TikTok is banned in the US, some positively and some negatively. The likes of Meta, Snap, and Alphabet would all probably gain some of the 170 million users looking for a platform to consume or create short-form content on. While beauty companies like Ulta, Coty, L'Oreal, and Clinique owned by Estee Lauder, retailers like Resolve, Crocs, and Walgreens, and music companies like UMG and Warner Music are likely to be impacted given their reliance on the platform. Next up from S&P Global, China and UK expand mining presence in Africa, while US, Canada, and Australia lose ground. What's our take on this news? Resource nationalism is on the rise, and certain countries need to access key commodities regardless of geopolitical issues. While the US, Canada, and Australia are still the largest non-African countries owning mines in Africa, with roughly 400 mines each, these numbers have declined by about 5 to 8% since 2019. They've lost ground to the UK and China, who have increased their number of mines by 11% and 21% to reach around 325 and 300 mines, respectively. UK-owned companies are buying into junior exploration companies in gold and lithium mines, while Chinese state-owned entities are buying into projects that have pre-feasibility or feasibility studies and have been de-risked rather than greenfield explorations. Africa is a resource-rich region, and those countries that need access to these key commodities will likely continue to invest and establish their presence. Next up from the Financial Times, US and Japan near deal to curb chip technology exports to China. What's our take on this news? Talks of export controls are creating a possible tit-for-tat situation amongst the countries involved. The US has been in talks with Japan and the Netherlands for months about establishing export control regimes that would exempt them from the US's foreign direct product rule. The US wants to limit China's access to advanced chips and servicing, like software updates, and exempt its allies like Japan and the Netherlands from these strict export rules. However, limiting exports to China would impact the likes of ASML and Tokyo Electron, so they're trying to find solutions. Meanwhile, Japan wants to reach mutually beneficial agreements with the US, but it's concerned that China may then restrict the export of critical minerals to Japan if they side with the US too much. The current US government has incentives leading up to the US election to continue strong arming arrangements, but it needs to be careful because the Dutch and Japanese counterparts could walk away from the trilateral mechanism created years ago if they are too aggressive. Next up from the BBC. Electric cars now outnumber petrol vehicles in Norway. What's our take on this news? It goes to show that the European Union's EV targets that people saw as too optimistic were actually quite achievable with the right incentive structure. It's been hotly debated whether or not the EU's ban on petrol vehicle sales from 2035 was too aggressive and threatened to destabilise transport infrastructure. Norway has seemingly proved doubters wrong when it set a target for all new cars being sold to be zero-emission vehicles by 2025, 10 years ahead of the European Union's goal. It looks like Norway is well on the way to achieving this too, because all electric vehicles made up a record 94.3% of new car registrations. Norway is quite unique, however, with the Norwegian government offering hefty subsidies for those buying EVs, paid mostly through royalties from Norway's oil and gas industry. The high price of petrol vehicles also contributes to increased uptake of electric vehicles. While the subsidies were previously quite extensive, a lot of them have actually been phased out already, a sign of a more permanent shift in consumer behaviour. And lastly, from Axios. Most CFOs say now is not a good time to take risks. What's our take on this news? Less investment and risk-taking could be the canary in the coal mine for an economic slowdown. Only 12% of CFOs said that now is a good time to take greater risks. This survey was done in July, though, around the same time as the political turmoil and assassination attempt on presidential candidate Donald Trump. Since we've now received a 50 basis points cut from the Fed and there is less uncertainty around the US election, these figures may be a bit different. While the figures could be very volatile due to unforeseen circumstances, keeping your finger on the pulse of how eager or reluctant big companies are to invest is a good proxy for guidance on economic activity. Now, let's dive into the main piece. The pros and cons of home country bias. Home country bias is a recognized tendency for an investor's portfolio to be extremely overweight in the country where they live. This chart from Vanguard compares the average portfolio of investors in each country with that country's weight in a global index. As we can see here, for most investors, portfolios are extremely overweight in investments from the country in which they live. Now, being overweight isn't necessarily a bad thing. In fact, there are several good reasons why a bias towards investment from your home country may benefit you as an investor. Firstly, there's practicality. For the majority of investors, it's a lot easier to invest locally rather than setting up investments and bank accounts offshore. Keeping track of investments in different countries would also be a challenge, but your Simply Wall Street account makes this a breeze. Then there's retirement funds. In many cases, retirement funds and legislation dictate what types of investments can be held. In particular, you may not be able to invest directly in shares offshore. Then there's matching assets with expenses. There is a good reason to ensure a chunk of your assets are in the same currency and invest it in the same economy as your future expenses. This helps you stay on the right side of currency movements and inflation. Then there's fees and costs. Although it's largely dependent on which broker you use, there may be additional brokerage fees for investing in companies listed on foreign exchanges that aren't also listed on your local exchange. It's rare that these costs will be prohibitive, but you've got to assess the opportunity cost of investing in that foreign company with higher transaction fees to a similar domestic company with comparatively lower transaction fees. And then there's time zones. For investors with longer time frames, like us, this may be less of a concern. But there are times when being in sync with the market opening hours for an exchange is beneficial. Perhaps prior to a market open, there's a price-sensitive announcement that materially impacts your narrative on a given company. For domestic stocks, you're afforded the opportunity to assess this new information and arrive at a new investment decision that can be actioned while the market is open. For companies listed on exchanges that may be open while you're asleep, you may be a day behind the market with respect to new information on the company. As with most things in life, there are both pros and cons to having a significant bias towards domestic investments. So, what are the risks of being overweight in investments in your own country? Firstly, there's missed opportunities. If you want to invest in the best companies in the world, you'll probably need to go to them. Investors with no US exposure over the last 20 years would have missed a lot of great opportunities. Then there's sector diversification. Some countries have very few listed companies in certain sectors. Even more typical is that there might be very few quality companies in certain sectors. If that's the case, diversifying across several sectors in your local market could leave you owning a few very mediocre companies. And then there's the downside risk. Every country comes with certain country-specific risks. Emerging economies carry more risk, Turkey and Argentina being good examples. But things can go wrong in any country, as UK investors have realized over the last few years. So here's a reminder. When currencies lose value, stock prices usually appreciate, offsetting that loss. That helps your savings, in the form of stocks, keep up with inflation, but it can give you a false sense of confidence, as shares that are underperforming in real terms appear to be doing well. If the currency loses value, it's worth keeping track of the value of your portfolio in hard currency terms. Now, to diversify or not to diversify, that is the question. So, this begs the question, to diversify or not diversify? One of the best arguments in favor of diversification is average annual returns by decade for the major stock markets. As we can see in this chart, there's little correlation between average annual returns from one decade to the next. This makes sense. If you can remember back to our deep dive on the Australian market, you'll remember that Australia's economy is heavily resource-based and their trade relationship with China is one of the key factors influencing overall market returns. The cyclicality of the resource sector and the peaks and troughs in China's demands for those resources meant that Australia's market's average return was inconsistent from one decade to the next. Australia is one such example, but it's relevant to almost every country in that list. It's incredibly rare to string together several decades of strong results due to factors outside of our control. Think back over the last 2 decades alone. The world grappled with a global financial crisis in one decade and was then shaken up by a global pandemic in the next, and that's just on a global scale. On a country level, there have been drastic changes in economic policy, changes in government policy, new industries emerging, and changes in consumer behavior over the years that have all influenced whether a market is in a period of boom or bust. Ultimately, diversifying your portfolio across a range of markets can help prevent these factors weighing too heavily on your return. A globally diversified portfolio may not experience the full uplift of a domestic boom, but it will weather the periods where market returns are less than stellar better than a portfolio overweight in domestic assets, effectively smoothing out the ride. Remember, returns come from a combination of both earnings growth and changes in valuation. Valuations vary the most when a country goes from cold to hot to cold, and that happens when investors chase returns. Now let's talk about understanding the difference between a local and global focus. Diversification isn't as simple as picking a company that trades on a foreign exchange and adding it to your portfolio. It's important to understand that irrespective of which market you look at, some companies are locally focused and some have a global presence, and these companies will enrich your portfolio in different ways. So firstly, let's talk about globally focused companies. The most profitable companies in the world today are global. These are large multinationals that have a presence across many different markets. These companies are less impacted by factors on a local scale and are more impacted by global economics and policy changes. Take Apple, for example. Although Apple is based in the US and is listed on US exchanges, there are factors like intervention from EU regulators and expansion into emerging markets in Latin America and Asia that are just as likely to influence valuations as anything local is. If your goal is to reduce volatility in your portfolio, then gaining exposure to globally focused companies can be an effective way to do that. Their large operations and geographically diversified nature should mean that their returns are less prone to large fluctuations. Here are some ideas for some globally focused companies. The digital economy is a global phenomenon, and a lot of the software and tech companies that contribute to it have a global reach. Your first thought when it comes to these types of companies will be Silicon Valley, and who can blame you, with it being the home to many of the largest global tech companies. But let's shine a light on some of the other tech giants from around the world. You've got the likes of SAP SE in Germany, Samsung in South Korea, Infosys in India, Constellation Software in Canada, Xiaomi in China, and Atlassian in Australia. Global consumer goods companies are generally well diversified and have compounded returns for decades. These companies may not have the excitement of a high growth tech company, but steady single digit sales growth and a wide moat can produce better long term returns than sporadic periods of rapid growth. Here you've got the likes of Nestle in Switzerland, LVMH in France, Sony in Japan, Media Group in China, Adidas in Germany, and Tesco in the UK. Now let's talk about locally focused companies. While these locally focused companies are also listed on foreign exchanges, their businesses are much more isolated from global factors. Banks, insurers, retail stores, and food producers often operate in a way that solely serves the local market in which they're listed and are unique to each country. They can offer exposure to market-specific factors like increasing consumer spending in particular countries, new economic policies, or to capitalize on new emerging industries, but this can be cyclical. If your goal is to lower the correlation between the returns in your portfolio and look for stocks that may zig while your domestic investments zag, then searching for locally focused foreign investments could be effective. Simply Wall Street's Stock Screener is a great way to discover some great locally focused companies from around the globe that will give your portfolio an extra kick of regional diversity. You're able to filter results by industry and, most importantly, by market to find some great opportunities that you might otherwise miss if you focus solely on your home country. Next, let's talk about emerging markets. Some of the most interesting locally focused companies can be found within emerging markets. Emerging markets present investors with unique opportunities to gain exposure to trends that you may not see in developed markets. For example, emerging markets are often categorized by the emergence of a middle class. This middle class generally has greater levels of disposable income. Higher disposable income leads to changes in purchasing behavior and consumer products, and retailers begin to grow their presence and thrive as the retail model shifts from local markets and vendors to large retailers. We've previously dived deeper into some really interesting emerging markets like Mexico, which is undergoing a period of growth from the benefits of nearshoring. We've also touched on India, which is in the midst of an economic modernization that is seeing many new industries flourish and millions of the population entering the global consumer class. These economies aren't alone. With 4.3 billion of the world's population living in emerging markets, there are opportunities around the globe to explore in the search of diversifying your domestically over-concentrated portfolio. While emerging markets offer some great opportunities and investors can be rewarded with monumental returns, they aren't a golden ticket to a successful portfolio. As with all things, there are important risks to note when considering investing in emerging markets. Firstly, growth opportunities don't guarantee success. When it occurs, growth can be phenomenal, as you can see with India's HDFC Bank's earnings, which increased by nearly 800% in the last 10 years. While some emerging markets will have short periods of great returns, on the whole, things haven't been smooth sailing, and the MSCI Emerging Market Index has actually underperformed both the S&P 500 and the MSCI World Index on a year-to-date basis, 1-year basis, and 5-year basis. Then there's also the fact that higher interest rates have been brutal to emerging markets. Emerging markets often have a high dependence on debt that is priced in the US dollar, which becomes more expensive as the interest rate rises. That's not the only issue either, as hawkish monetary policy is a tool to slow economic growth. Higher interest rates can further negatively impact emerging markets that heavily rely on exports if imports into developed countries slow in response. Now let's briefly talk about getting international exposure through ETFs. Most exchanges now offer investors the chance to diversify globally with ETFs. As we've mentioned before, ETFs are a great place to start when it comes to diversifying, particularly in a global fashion. There's a few pros and cons that should always be considered. Firstly, purchasing an ETF is a lot more convenient than opening trading accounts on the other side of the world, and the brokerage costs of purchasing will likely be lower if the ETF is listed on your local exchange. These ETFs do offer diversification, but may include a lot of mediocre companies as a result. ETFs are a good start, but finding a handful of really great companies around the world could offer diversification and return, all without paying a management fee. So, let's wrap this up. What's the inside? understanding how to diversify is just as important as diversifying itself. When seeking to globally diversify your portfolio, there are some key considerations. Firstly, think long-term rather than the immediate outlook. There is a lot more to it than just considering the individual company catalysts. Consider the catalysts that contribute to a great business environment where companies thrive. Last week, we discussed a few factors that are indicative of a market that is more friendly to investors, which tends to make things easier for foreign investors. Check them out in last week's Market Insights if you're interested. Consider each market's exposure to long-term secular trends too. The way a narrative can play out in your home country can be completely different to how it plays out in other markets. Each market has its own unique economic traits, age demographics, and laws that can see secular trends play out in wildly different ways. This can be both an advantage and a disadvantage. Secondly, balance out home country bias. Pick markets with strong sectors that are underrepresented in your local portfolio. Exploring the exchanges of global financial centers is a great place to start, as they offer access to regional and global companies. Examples here include the US, the UK, Switzerland, Singapore, and South Africa. Ideally, offshore investments should help you spread the risk and offer the chance for exceptional returns over the long term. And lastly, GDP matters less than you might think. Countries with higher per capita GDP do have higher stock market value to GDP ratios. However, interestingly, several studies have shown little correlation between GDP growth and stock market returns. Higher GDP leads to more companies becoming publicly listed, hence the higher market to GDP ratio. The highest ratios occur in markets that become financial centers and attract dual-listed global companies and regional companies. Now, let's wrap up with the key events during next week. On Tuesday, the Reserve Bank of Australia's interest rate decision is due. Unfortunately for mortgage holders, and fortunately for savers, the ASX interest rate tracker indicates a 90% probability that rates go unchanged and remain at 4.35%. On Wednesday, Australia's CPI indicator for the month of August is due to be published. The last few months have seen inflation cooling again after it spiked again in May. July's inflation rate came in at 3.5%. On Thursday, the final US GDP growth figure for Q2 is due. The forecast of 3% is up from an earlier estimate of 2.8% due to increased consumer spending. And on Friday, France's preliminary year-on-year inflation rate for September is due. Inflation has slowed to 1.8% in August, but a slight increase to 2% is forecast for this month. United States Core PCE Price Index for August is due. This index is the Fed's preferred gauge for underlying inflation. July saw 0.2% growth reported, and the same is expected for August. US personal income growth is due for the month of August. Growth is set to be similar to last month, with 0.3% growth forecast, the same as July's result. US personal spending growth is also due. July's results were marginally hotter at 0.5%, but this is set to slow to 0.3% growth for this month. There are still some companies that are yet to report their earnings, and some to note are Costco, Accenture, Micron Technology, Cintas, AutoZone, and Jefferies Financial Group. That's all for this week's Market Insights. Thank you so much for listening, and until next week, invest well. Simply Wall Street analysts Bailey Pemberton and Simply Wall Street have no position in any of the companies mentioned. This article is general in nature. We provide commentary based on historical data and analyst forecasts only using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock and does not take into account your objectives or your financial situation. We aim to bring you long-term focused analysis driven by fundamental data. Note that our analysis may not factor in the latest price-sensitive company announcements or qualitative material.